Thank you for attending our event today, the topic of which is considering cybersecurity when making business loans. Protecting collateral and reducing risk for banks and others making business loans, presented by Ray Hutchins and Mitch Tannenbaum. Mitch and I own a full-service cybersecurity company headquartered in Denver, Colorado, and we've been making presentations lately to business valuators and discussing business valuations. And with business valuators historically have not been considering cybersecurity as an issue when they're valuing businesses, but that's changing. And if business valuations are changing, then that means the collateral behind loans is changing. And we know that certain bankers are starting to think about, hey, maybe we shouldn't be asking questions about, cybersecurity before we loan these people money. And so that's what we want to talk to you about today, the factors that we've been introducing to business valuators, because they relate to what anyone is doing when they're trying to understand what's the value of this asset that I'm loaning money against on this thing. So an overview, we're going to try to make this pretty fast. Try to get this done in 15, 17 minutes, something like that. So if you have any questions about it, want to know more about it, you'll see there's our website on every page. Just go to our web page, contact us, feel free to contact us. Okay, number one, why cybersecurity should now key consideration loan decision process. 2 types of business scenarios where cybersecurity plays a key role in loan risk. Real-life examples of effective cybersecurity benefits to lenders by considering cybersecurity and valuations. How to determine if cybersecurity is really a risk factor. In some businesses, it wouldn't be a risk factor, and we're going to give you the questions that we would ask to find out does this matter or not. So risk affects valuation, okay, and cybersecurity is a risk. Now, if as a banker you're kind of questioning that, then that's for another time to be thinking about that or talking about that. But we're making these assumptions right now. Today, in today's world, most companies operate on top of an IT infrastructure that is inherently insecure. That's a fact. The greater dependence upon the IT infrastructure to operate the business, the greater the risk. If a company cannot effectively defend its IT systems and its data from attack, then it is a riskier lending proposition than a competitor that can defend itself. Weak cybersecurity can be an indicator of weak leadership. Weak leadership is a warning sign that the company may fail. Cybersecurity matters today. In today's world, a company's value is directly related to the amount and value of intellectual property data, customer data, application software data. Any company that builds its own software applications. Third-party vendor data is important nowadays, and the amount of unmitigated, as unmitigated means fixed or not, so unfixed, cyber risk. Additionally, that value is impacted by accessibility to that data, security of that data, safety and security of the systems required to use that data, and the commitment to security by the people controlling that data. All important factors. If the lender is not aware of these issues and does not ask questions related to these issues, then how can the lender understand the lending risk?
We just saw a case where a company here in Colorado was hit by a ransomware attack. They didn't have appropriate backups, and the result of that was the business shut down. Now, if there was outstanding loans, I mean, it's possible. You could sue the owners of the company. Maybe the owners of the company were personally liable on the loans, maybe not. But certainly you're in a position where your ability to go off and get loan payments and get the loans paid down becomes impacted when a cyber event occurs.
If you're a loan officer in a bank and you make a loan to a business and the business fails related to a cybersecurity issue, and you go back and look at the history of how the loan was put together and there's no questions about cyber risk, somebody's not doing their job. Real life examples. So we're going to give you a couple of examples of how the valuation or the value of a company was impacted because of cybersecurity. We're using large publicly traded companies as examples because there's the data available that we can see. And large companies have the resources to deal with the breach. They can go on and have a life afterwards. Small companies file for bankruptcy protection or dissolve. So Mitch, would you take this, please?
Sure. So in the case of Target, they were hit with a breach back in 2013. I remember this is 2019 when we're recording this. This is still an active event that's going on in Target's management's life. It affected 40 million credit cards and 70 million loyalty cards. And they paid almost $20 million in fines, more fines coming, $154 million in settlements, more litigation still on the plate. And in the 2016 annual report, we saw a number that said that the breach had cost them almost $300 million. Now, the good news for Target is that they have a lot of assets, and so they could go off and spend this money. In their case, they got the money back from the insurance company months or years later. So, but even so, they spent $192 million as of 2016 out of their own pocket. So let's assume that your breach was, say, 1% of the size of the credit card of the Target breach. So now we're talking about, maybe you're going to spend, $3 million, of which $1 million comes back from the insurance carrier. So you're writing a check for $2 million. Is that something that you feel comfortable doing out of your checkbook? Bigger issue here is an incredible amount of distraction. So it may not overall, in these publicly traded companies, the stock price recovers, everybody goes happy along their way, but the executives of the company are distracted for years by depositions, by figuring out what their legal strategy is, by dealing with, trying to get insurance companies, and sometimes it gets really wonky, trying to get the insurance companies to pay out when they have these breaches. The management team is severely distracted by these things. I think we're on the next slide, Ray, by the way. Yeah. And this is an unfunded liability. For a lot of companies, they don't have any cyber risk insurance at all. So whatever happens, even if it's $500,000 of costs, that's coming out of your checkbook. If we move on to Yahoo, another very publicly known breach. That breach happened at an interesting time. It was right at the time that Verizon was in negotiations to buy Yahoo. They had already agreed on a price. They'd already agreed on a deal, and then it came out that 3 billion accounts, but no credit card data, right? This is all email and account access were compromised. So the first thing Verizon did said, well, we're not so sure we want this deal. So that kind of made the Yahoo shareholders nervous. And then they said, well, maybe we'll take the deal, but we want a price discount. How about, a couple $100 million, take right off the purchase price. And oh yeah, by the way, you're going to retain a bunch of the liabilities and a bunch of the costs associated with this breach on top of it. So if you were a Verizon shareholder, that was a perfect time to go off and for that breach to become public, because you got to negotiate down the price significantly. On the other hand, if you were a Verizon shareholder, that really sucked because they got to negotiate down the price. Now, if the breach was announced after that deal closed, there would have been lawsuits and counter lawsuits going back and forth, all of which cost money and all of which is a distraction. So, and that one is still not settled. They're still going on. In fact, recently there was one settlement negotiation going on where the judge said, nah, I don't think this is right. Why don't you try again? And the real question becomes, if you're a smaller company, would you be solvent at that point? Would you be able to make your loan payments? Would you be in compliance with the covenants of the loan? And as a lender, that's something you need to consider, because you read in the news about all these different breaches that happen all the time to companies of all different sizes, and we see that in our business, from 3-person companies to big multi-billion-dollar companies. The hackers really don't make much of a distinction. They go after anybody, right?
Okay, so benefits to a lender if you're considering cybersecurity as part of the loan process. You're reducing the risk and the liability associated with loans that don't factor in cybersecurity. So and you're bringing more value, you're bringing value to your clients actually, by bringing cybersecurity to their attention when many times they might not even be thinking about that. And you're protecting the value of your loan. It is our position, like I mentioned earlier, that banks are not doing their jobs anymore in today's world if they're not factoring cybersecurity into their loan process. So we had some questions that we made up for valuators, to determine if cybersecurity was a valuation factor. And we're using these same questions to see if is it a lending risk factor. And we've got a high threat score. This is a service that we provide to valuators. We give them these 10 questions. They ask the questions. If they have a high threat score, they'll send us the answers. If they have a high threat score, then we suggest to them that they do a full risk assessment, and then we can help them fix the problems.
And this applies to lenders just as well, right? If you go into a deal where you realize that there's a high risk score at the time of which you're considering making a loan to a business, then you need to go rethink that. Is that loan priced correctly? Do you have the right collateral? Do you have the right terms? Do you have the right conditions? All those should be a factor in the loan decision-making process.
And the more you know about the cybersecurity posture of the company, the better position you are in to evaluate that and make the correct decision on that and reduce your risk. So here are the 10 questions, the 10 test questions that we suggest that you use. Does the company have sensitive data that it is responsible for protecting and that might be of value to competitors, criminals, or foreign governments? Intellectual property, client data, non-public personal information. If the business is a beauty parlor or a business like that, well, okay, no, you're really not worried about it at that point. Is the business a mortgage lending company? Oh God, they got all the information. They can't lose that information.
And you kind of have to think outside the box a little bit there. When we saw the Marriott breach a few months ago, what we discovered after the fact that we think that was a nation state, likely China, who's trying to surveil its citizens. They didn't break into the Marriott to go off and steal credit cards. In fact, none of those credit cards have shown up on the dark web, which is what's leading people to think that it was a nation state that wanted it. They wanted the data for their own nefarious purposes.
China as a country steals business data from businesses and gives it to their businesses to help them compete globally. We had a client who was in the construction business and came up with a little formula for concrete to improve concrete. They were showing off their stuff at a trade show. The Chinese found out that, came in and stole it. I mean, not a national security issue, but certainly damaging to that business. Number 2, is the business in compliance with applicable state, federal, or professional cybersecurity, privacy laws or requirements? Quite a few different laws out there. If you're in Colorado, we have our own privacy and cybersecurity law. Anybody doing business in the state of Colorado has to comply with it. You've got California law, you've got GLBA, you've got HIPAA, PCI, you've got various, but if a business is trying to borrow money from you and it's not in compliance with cybersecurity and privacy laws, should you be lending them money? Number 3, does the business have a significant online presence? The more that they're online, if they're running a big catalog online, if they're doing transactions online, if they've got applications online and running them, that means they're vulnerable. You need to be able to assess that. How vulnerable are they? Number 4, does the company develop and or maintain online applications that collect sensitive information or which are crucial to the operation of the business? Those are warning signs for you as a lender lending your bank's money. Number 5, does the company have a written cybersecurity program? That'd be a question you'd want to ask, and you'd want them to give you that document. You'd want to look at it and say, do they have a program or not? If they don't have a program, you got a problem.
And you might remember after the Sony breach, we discovered they had done a risk assessment about 3 or 4 years prior to the breach. Now, having a program that was written 3 or 4 years ago, put in a drawer and nobody's ever looked at it again, that's not a program.
That's not a program, no way. You got to have an annual risk assessment by a third-party assessor. Is an executive level employee responsible for this program? Is their compensation tied to the cybersecurity of the company? If the answer to these 2 questions is yes, you're in good shape. If not, keep asking questions. Would a cyber incident that affected the company's reputation impact the value of the company? Okay, there's an important question. Would the company be negatively impacted if their online systems, internal or public, were taken out of service for a week or a month due to a cyber incident?
We're seeing this a lot with ransomware attacks in both the public sector, right, small local towns and counties, and healthcare systems where they get hit by ransomware attacks and they are, basically offline. I mean, we had, towns here, you hear about it all the time where, they can't even go off and issue a building permit or get people, allow people to pay their water bills or anything like that. They're literally out of business. Now, if it's a town, well, I guess you could move to another town, but you don't have any other choice for who you do business with. But on the other hand, we're seeing in the healthcare world where they have these breaches, well, the business goes to a different hospital and they lose the revenue and they probably don't ever get that revenue back.
What kind of cybersecurity insurance does the company carry? General liability does not cut it here. You have to have cybersecurity insurance, and those are non-standard policies. So that means that Lloyd's of London and these underwriters, they're using their lawyers to write very fancy, complicated policies that are very difficult to read. And if you don't know how to read the policy and understand it, you may not have the coverage that you think you have. So that's important for a bank. That's because that's protecting your loan, that loan money that you put out there. Has the company ever had a cyber incident that it knows of? Virus, ransomware, business email compromise, wire fraud, breach, NPI, et cetera, et cetera. If they have had one, how did they handle it? Are they recording it? Do they have any records about how they handle it? Do they have an incident response program? Do they have a disaster recovery, business continuity program? These are all things that if they don't have these things and they're not being kept up to speed and they're not doing the things they need to do and consider best business practices around cybersecurity, you as the lender have a problem.
And if they say they've never had an incident, well, either they're lying or then they really have a truly inadequate cyber security program because they don't even know that they've been had. We've seen this many times where hackers have been in there for 2, 3, 4, 5 years before people finally figured out that the hackers were in there.
And so this kind of goes back to, so banks, if you're a bank or a lending institution that's looking at this, maybe you have to go through FFIEC examinations around security and whatnot. If you're doing such a thing, but yet it hasn't dawned on the management that you should be looking at your loans over cybersecurity, what's the disconnect here? What is the disconnect between these things? I'm not getting that, frankly. And then we know enough about what the government is expecting of banks. And we're also, if you need any help with this kind of an examination, we're at your service on that as well. We have a lot of experience on that and have the tools making that happen. Mitch, can you expound on that a little bit, please?
Sure. As a financial institution, you're considered part of critical infrastructure according to the government. And as such, they hold banks to a higher standard of care in terms of protecting their clients' money. In part, that's because the government guarantees for most banks, whether it's the FDIC or NCUA or any of the different government guarantee institutions, the government is guaranteeing that money. They want to make sure that the risk for them having to pay out as a result of hackers stealing all of the money is reduced. So the FFIEC is a standard interagency organization that does cybersecurity assessments for larger banks and other financial institutions like big mortgage companies and stuff. But you have state banking regulators, you have other regulators that are looking at cyber risk, and they understand that, kind of the Willie Sutton problem, the hackers are going to come to the bank is because that's where the money is, whether the money is online or whether the money is in person. Now, it used to be when it came to, robbing a bank, you had to go in to the front door. You had to brandish your machine gun if you're, one of the guys back in the 1930s, and you ran the risk of getting shot. Nowadays, the hackers are halfway around the world. They are likely in a country that we don't have friendly relationships with, like China or Russia or North Korea or Iran. And the odds of them getting caught, we see the government indicting them Every few months they're indicting someone new. Almost none of those people, except accidentally, ever come to trial. So the odds of getting caught are very, very low. The payout, if you're successful, is very, very high, and the odds of getting hurt in a bank robbery are very, very low. Well, that's no different for any company that you lend money to than it is for you. And since the lending is based on the ability to repay, if there's a cyber incident, it impacts the ability to repay, then that's something that you should consider in your lending process.
One of the reasons we're making this presentation today is because while we're not a huge cybersecurity company, we're big enough and we're respected enough that we're called in various cases and whatnot. And we have seen, we're involved right now in a situation where we know a large bank, a good-sized bank, doesn't have very good cybersecurity procedures with respect to wire transfers and whatnot. And so we know that banks have a problem on this issue, and we're doing what we can to bring it to your attention. And so if you have any questions, if we can be of any value to you, please give us a contact. We're happy to help. Mitch serves as an expert witness in these kinds of cases as well. And so, Mitch, you have any closing comments?
There's a former director of the FBI who said that it's not a matter of if you've been attacked, it's a matter of when you're going to be attacked. That's true for you as a bank. That's true for your clients. It's true for everybody who operates a business nowadays. And if you don't plan for that, then you're going to wind up having to react to it. And reacting is never a great place to be.
Thank you, Mitch, and thanks to you for attending today's presentation.
Thanks.